All right, let's get this started. Welcome everyone to this TradeStation webinar. My name is Jesus Nava and my colleague Brandon Wendell. We're here to talk a little bit about options and highlight some of the content that our team has created regarding verticals. So before we get started, we have to do some disclosures and some introductions. So give us a minute while we do that, and then I'll pass the microphone over to Brandon. But Brandon is our guest speaker. He's a trader and he's an educator. So it's a privilege to have him here today. I am part of the education team as director of client training and education. So it's always great to be here and highlight some of the content that we've created in the past. Just some disclosure so that everyone is aware of the risks. Every symbol and idea that we talk about is not a recommendation of TradeStation. Also, that active trading is not suitable for everyone, especially with options, which carry a high degree of risk. And past historical performance is no guarantee of future results. We all need to be aware of that. Whatever happens in history is used as an example and is no guarantee of future results. If you need additional information on these disclosures, go to www.tradestation.com/important-information, and you'll find all the disclosures there about options and all the risks associated with trading online. One more thing, Brandon, even though it's a pleasure to have him here, he's not affiliated with TradeStation, and just wanted to make a point of that. So thank you for being here, taking time out of your schedules, and learn a little bit about TradeStation. Today is going to be a roller coaster of a ride. We have a lot of content to cover. This presentation or this webinar is specifically based on 4 different articles that we posted to the Options Education Center. If you haven't been to the Options Education Center, it's easily accessible by going to the TradeStation website. While you're in tradestation.com, hover over Learn, and then click on Options Education. That's where you're going to find all the articles, all the webinars, workspaces, custom studies. There's a lot going on in the Options Education Center, and I want everybody to explore all the things that are here. I'll share a link in just a moment right there in the chat so that everyone has access to this. But as I said at the beginning, this is a combination of different strategies in one single category. And I suppose, Brandon will go into more detail about that. But let me go ahead and stop my share. Brandon, I'm going to pass the microphone over to you. So it's all yours, Brandon.
Great. Well, thank you very much, and appreciate you guys having me here as usual. Should be good to go. All right. So there we go. Now you should be able to see my screen, and let's put the right screen up here. Just to introduce myself, some of you have seen me before here. I'm a trader first and foremost, and I am also a chartered market technician, which means I've got kind of a master's degree in technical analysis, if you will, where I've studied the markets quite extensively, how they work, how they don't work, and what works best for me. I basically got in the industry as a broker and moved from the front office where I was a trader for the brokerage in a back office where I was trading for the broker. I'm sorry, it's a salesperson first as a broker. Then I moved into a trading position for the brokerage. Ended up leaving that, becoming a hedge fund trader, left that and became kind of an educator. Because, well, I always joke, I say I'm genetically engineered for this because my mom is a school teacher, retired, and my father's a retired broker. So, you join those two traits together, and this is kind of what you get here. So I've been doing this for quite a while, and I just want to share my knowledge with you. That's kind of a lot of fun for me. So getting back to this and what we should expect today, basically, we're going to talk about vertical spreads. And you may be aware there are multiple types of vertical spreads. As Jesus hinted at, this might be a little bit of a whirlwind, but fear not, there are plenty of resources for you to catch your breath and kind of re-stimulate yourself. If you go out to TradeStation, and Jesus will probably put in the link a little bit, but under the TradeStation website, under Options Education, you got the Options Education Center. There it is. There are more detailed information on each of these individual strategies. If you just scroll through, you'll find bull put spreads, bear call spreads, bear put spreads, and so on. So plenty of information out there for you. But first, let's talk about why we even use spreads. And we're going to talk about the purpose for spreads is to help control the risk that you're experiencing in the markets, especially with options. You can control that risk a little bit better because there are different things that are imparting risk on your position. And you need to understand what those influences are and how to adjust for those risks and be aware of what they are. You should not be in the markets, period, if you don't know what risks you're facing and what your possible losses might be. We also need to figure out whether we should be buying or selling. When it comes to the spreads, there's two types overall. You have what are called debit spreads, where you are actually paying to enter into the position. And you have credit spreads, where you are receiving credit and putting down a margin deposit to be able to enter into a position. Well, there are some that are more appropriate than others, depending on the overall market environment and what's going on. So we'll talk about bullish vertical spreads, and there's basically two directions with vertical spreads. You can be bullish or bearish. You can combine those and become neutral, but individually, they're generally either bullish or bearish strategies. And as I said, there's either debit or credit. So we're going to focus on four different spreads. You've got a bull debit, bull credit, bear debit, bear credit. Yes, that gives us our four. So we're going to cover all those. Again, I'm going to go kind of cursory and spend more time on how to figure out which of these you might want to employ. To learn all the ins and outs of the strategy themselves, you can actually, again, go to the Options Education Center, watch the workshops, watch the videos, read the articles, and practice everything, please, in simulated mode first. TradeStation offers that simulated mode that gives you opportunity to practice your strategies in the real market environment, but without all the risk. And that's always a smart thing to do. So we'll talk a little bit about that and hopefully get to a little bit of practical application. You can also join myself and Jesus every other week. We get together for the options replay program. So if you're not familiar with that, make sure you check that out. And that's a lot of practical application as well. We're going to be focusing more on how we actually navigate the OptionStation Pro and TradeStation to affect a lot of these strategies rather than just discussing the strategies themselves. So getting into the Greeks, we have five Greeks that we're dealing with: delta, gamma, vega, theta, and rho. And those are basically risk parameters in the market, and the options market specifically. We don't give rho a whole lot of attention, predominantly because it's only going to change when the Federal Reserve changes interest rates. So that's an effect on option pricing because of what they call cost of carry. Obviously, you could use your money to purchase securities, or you can use the derivatives, the options, and get extra leverage and not have to pay as much. Well, because of cost of carry and margin fees and things like that, there's an interest rate attachment and risk to all of your trading, especially with options. So we're going to focus on some of the others: delta, gamma, vega, and theta. And they basically help you identify how sensitive you are to risk. Delta would be risk of directional movement. It tells you how much the option price is going to shift when the underlying security moves, either up or down. So that could be a positive or a negative, obviously. Gamma is a rate of acceleration of delta. And it talks about, or tells you how fast the delta will change. In a way, delta is your miles per hour in a car. Gamma would be the pressure you're applying to the accelerator pedal. So if you start pushing the pedal down more, what's going to happen? Delta, your speed is going to increase. If you let off the pedal, you're getting less gamma. Your delta, your speed is going to decrease. So that's one way of thinking of it. Vega is probably the biggest one of all when it comes to impacts, and that's volatility. So that tells you how much volatility is going to affect your option pricing. Generally, as volatility increases, the value of options also increase. So typically, when volatility rises, the values go up, the prices, the premiums go up as well on options. And when Vega drops, typically so do the prices of options. Also, when it comes to Vega, not always, okay, again, Vega is volatility, but typically volatility rises as underlying security prices drop. But Vega can rise if prices go up quickly. Okay, so it's normally associated with fear in the markets as prices drop, but not always. Keep that in mind. There's a saying in technical analysis, I always joke, I say, everything happens except for when it doesn't. There's nothing that's 100% foolproof in the markets, unfortunately. So Vega, again, typically will cause prices to rise when Vega rises and will drop when Vega drops. Prices, that is. Theta is time. I guess that's one certain. Time will pass. And time decay on options is something we have to be aware of. So theta is how much time decay you will experience for every 1 day of time passing. Weekends are included, so are holidays. What happens with theta is it's not linear, if you're not aware. It is kind of a curve. The closer you get to expiration, the faster the theta starts to work on your option, the faster you start to decay. So when you have 30 days left until expiration, the theta is increasing exponentially. It becomes the biggest. So we're going to use spreads to help neutralize these and reduce the risk to certain Greeks. If we want to, we could actually completely remove most of the delta in an option spread. That means it doesn't matter if prices go up or down, we can be close to or at delta neutrality. Or we could be gamma neutral, or we could do vega neutrality, or we can do theta neutrality. What that means is we are capturing one option that has certain characteristics, certain delta, vega, theta, gamma, and then we take another option that has negative, or not really negative necessarily, but opposite Greeks of the first one, and they cancel each other out. Now, they won't cancel each other out 100% all the time, but we can do this enough that we reduce risk. So let me explain a little bit more. Taking a look at a call option right here, and it doesn't matter what it was, it's just a random call option I picked here. And looking at this, the first option you choose in a spread is called the anchor leg. It's anchoring the position. With the anchor leg, you're basically driving the strategy. It's the one that creates the profit potential. Okay, so if we're buying an option in this case, and a call, if I buy that 210 strike for the ask of $3.40, I am basically deciding that, okay, I am buying this call option, and my delta, which in this case is 0.59, for every 1 point that security rises, the underlying, I will gain 59 cents in the option premium. So I am delta positive, meaning if prices go up, my value goes up. That's the option driving that profit. I also have a vega of 0.12, which also means that if volatility rises is positive, I will benefit from that. My option is likely to go up in value, and I have positive vega, so I will see the prices go up with volatility rise. But I have negative theta. That means as time goes by, every day I lose just because of decay, because time passing. I think of options like ice cubes. As soon as you take them out of the freezer, they begin to melt. And if you have a large chunk of ice, it will typically melt slower than a small sliver of ice. Meaning if you have a lot of time left, it melts slowly. The options decay slower than if you have a small amount of time left, it'll decay faster. So if we want to neutralize one of these, say we don't want to have some time decay to worry about, I have to find another option that has positive theta to counteract the negative theta that I have here. Or if I wanted to trade just volatility and not worry about the direction, I could find an option with negative delta to offset the positive delta that I have. All we do is we take that anchor leg, which is going to drive our decision in the markets. Are we bullish? Are we bearish? Are we going to be looking for sideways movement, whatever it may be? Okay, maybe I want to play just the volatility. I find something that has good volatility. This has the highest vega on the screen right now. So if volatility is getting ready, it's very low, I'm expecting it to rise. Perhaps I selected that option. But I'm worried about delta and theta. So now I need to create what's called an offset leg. The offset leg is the second option that you choose. This was actually Take-Two Interactive, as you can see. And I was buying the call, the 210 call, which had the set Greeks. I can't change those Greeks, right? There's nothing I can do about it. I bought that option. I'm accepting those Greeks. I'm accepting that risk. If the price of that security dropped by $1, I would lose 59 cents in the option, period. Okay. If volatility dropped, I'd lose 12 cents. If time goes by, I'd lose 18 cents a day. There's nothing I can do about that. But I can counteract some of those now by adding another option. The offset leg offsets your undesirable characteristics. In this case, I was selling the 220 call. I don't know if it's showing here. Yeah, here it is. You can see the 220 call has a delta of only 10. Okay, so it's not going to neutralize 100%. Since I'm selling the options, all these operators reverse. So negatives become positives. Positives become negatives. And remember, this is just showing single options right now for one share per share. So when I'm looking at this, it's actually multiplied by 100. So what we've done is we've taken delta of 59, technically 59, not 0.59, and subtracted the delta from the 220 call. And you can see it was 10. That should be about 49. Well, it adjusted since I took the pictures. Unfortunately, I couldn't take them all right at once. So by the time I took the picture, it adjusted a little. The delta for the entire position with the anchor and the offset leg dropped from 59 to 47.91. Now, why am I making less? Why wouldn't I want to just keep the 59? Because I'm trying to neutralize some of the other Greeks. I'm trying to reduce my risk. Anytime you reduce risk in anything with markets, anytime you reduce risk, you automatically reduce some of your profits. That's the cost. If you don't want to do it, take the risk. Greater risk, greater rewards. Less risk, less rewards. They go hand in hand. So I have gone from a 59 delta down to 47 delta, but what's the benefit? Well, volatility. Perhaps this was a little bit higher than I'd like for volatility right now, and I don't want to be exposed as much to volatility if just in case it drops. Remember, if I'm bullish, volatility might actually drop if we do go up gradually and slowly. So my Vega went from 12 to 6.43. So I gave up a little bit here in my directional reward and risk, but I cut my volatility risk in half, almost in half. You see the balance there. And my time risk went from 18, negative 18. Again, it's a negative because it's going against me. Time is decaying. Now it's only negative 9. So that small amount that I gave up here of what, about 11 point something, $11 per dollar per point, right? From 59 down to 46, we'll call it 48. Keep it easy. That's 11. I was able to cut my volatility and my time risk in half. That's why we do spreads right there, period. Offset legs customizes your strategy and reduces your risk, but at the cost of reducing your profit. Hopefully this makes sense to everyone. Great. I'm glad it does make sense. So volatility, let's start jumping into some of these Greeks and see again how they're affecting us. I kind of mentioned it already, but in the CDNS, you could see on the chart, I have implied volatility versus historic, because implied volatility is the one we're really focusing on. If you're not familiar, historic volatility is what has happened in the past. It's basically what you're seeing on the chart. That's historic volatility. It's also known as statistical volatility. But if you want to see what's coming up or worried about what's coming up, that's implied volatility. So I have two indicators from TradeStation here: implied volatility divided by historic. It's a ratio. And the higher it goes, the more implied volatility you have, and therefore the higher option prices are likely to go. Then we have implied volatility, all options on the bottom, and it's along with an average. So this is the, I can't remember what you can actually look on TradeStation to see exactly what this indicator is telling you. I forget what it is, to be honest with you now. So if I go to my TradeStation, add study, so implied volatility, all options. When I click on it, I can actually go to definition and the help will pop up and it'll explain exactly what is this measuring, which implied volatility. Now it says for all the options for the underlying asset. So it's basically looking at all the implied volatilities of all the options and spitting out that data for me. So I'm just going to put that on my chart, but then go back to my slide. And basically what we see is that volatility can have a huge impact on option pricing. Typically, volatility going up increases options prices. That's what I was just saying. Volatility going down and getting below the average, that can decrease option prices on it. Typically, again, it's not 100%. It doesn't work every single time, but that's what happens most of the time. We want to take a look at what's going on with our implied volatility. This is the same indicator. I just changed the colors. I kind of like the yellow instead of that blue, but it's this implied volatility, all options. That is showing us our current implied volatility of all the options on that particular security, Micron. and the average over a period of time. I think it's 20 periods, which is roughly one trading month. We have about 20, 21 trading days every single month, except for February. So what we're going to be doing is basically comparing the current implied volatility to the average and where it's been in the past. You could use the average line. You can just look and eyeball it and see whether implied volatility is relatively high or relatively low. Now, when you think about it, I said volatility is directly related to the value of options, the options premium. So if implied volatility is low, that would suggest that perhaps option prices are relatively low. And if volatility is high, then option prices might be overvalued or high. Well, it's common sense. What do we do with something that is undervalued or cheap? We buy it, right? So we'd be looking at debit spreads or buying options typically when we have implied volatility relatively low or under the average. Okay, now this is not 100% a blanket statement. Okay, you got to realize that every situation is going to be a little bit unique. You got to do your own analysis. But on average, you typically want to buy cheap options in low volatility environments, expecting that the volatility will rise, therefore taking the value of those options upwards. Conversely, if volatility is extremely high and it's likely to come down, remember, it could always go higher. Things can always go lower. It can only go to zero, right? But things can always go higher. But on average, if volatility is very, very high and option prices are extremely overvalued, you're probably better off selling them. So that way, when the value drops, you can buy them back cheaper. So you can compare it to the current implied volatility. Compare the current implied volatility to the past and to the average. You could also, again, create indicators. This is an indicator that was actually on one of our, in one of the workshops available, or not workshops, workspaces. You know, all these workspaces that I've been using in charts and things like that are available to you in the Options Education Center. They're all available for everyone to download and use. So there's an indicator that basically is taking, this is the current implied volatility in red, and it's looking at the historical volatility in blue and its range over the last 52 weeks, high and low. And it's basically, in this case right now, it's saying we're relatively low in comparison to the last year's volatility. Okay, we're actually in, this is 20%, 40, 60, 80, 100, those lines. So we're at about 30%. I know it says 44.96. Don't worry about what the number is. This is about 30% in the 30 percentile of last year's historic volatility range. Now, could it go lower? Absolutely. But the probability is when you have low volatility, you're likely to go back up. So therefore, if we're low, we probably want to buy. If we're high, we want to sell. It's just a way of identifying whether we should be debit or credit spread traders. Putting it all together, I already said all this, but now you have it visually as well. Low volatility might mean that options are inexpensive. We'd most likely look at buying debit spreads because the options are relatively low price. And if volatility goes up, even if prices don't necessarily go up, we can still potentially profit. And if volatility drops, again, you might lose value because the options go down in value. So if we're bullish, a bull call spread is the debit spread that we want to take. And if we're bearish, we do a bear put spread. This is helping us decide what type of spread to do, and it's a debit spread. The IV gauge is actually, I forget which workspace it's in. The different workspaces, you'll find it in one of those. I didn't actually open up the workspace yet, did I? There we go, workspaces, open workspace. I guess I could have just done the Control O as well. But anyway, there are 4 workspaces: bull call spread, bull put spread, bear call spread, bear put spread. So for instance, bear calls, and they're again, all available. You can just download them. The indicator's already in them as well. And all the directions are there too. I just don't remember off the top of my head which one it's in, but I'll open that workspace right now. Once it opens, I'll show you where everything is. If we have high volatility, we pretty much want to do the opposite. High volatility means options are overpriced. We want to possibly sell. If volatility drops, the values of the options should drop. We could buy things back at a cheaper price. If volatility goes up, however, we chose wrong and we might lose. So the two strategies there are the credit strategies, either a bull put spread or a bear call spread. Those are the two strategies you might want to employ when you're in a high volatility environment, expecting prices and volatility to drop. So, I mean, that's one of the biggest decisions. Basically, when it comes down to trading options, I start off, I know it's oversimplifying a little bit, but it really doesn't need to be too complicated. Okay. Simple doesn't necessarily mean easy, by the way. Okay. But when it comes to trading options, I take 3 steps. You know, I joke, I say it's like Leonard Skinner trading. Give me 3 steps. Step 1, are you bullish, bearish, or neutral on the underlying security? Okay. If we're bullish, we're looking for bullish strategies. If we're bearish, we're looking for bearish. If we're neutral, we could trade other things. There are other strategies to employ on those. That's number 1. Are you bullish, bearish, or neutral? Number 2, are options cheap or expensive? Well, we just figured out how to figure out if they are cheap or expensive. For instance, here's my workspace, and this one doesn't have the implied volatility on it for the bear call spreads. Actually, I have, and you can see actually on this workspace, which is the straddles, that one does have implied volatility right there, historic and all options. So maybe I should have kept that one open. Anyway, we'll get back to that in a little bit. So, like I said, what we can do is to figure out which direction we may want to trade, do our technical analysis on the underlying security, or on those workspaces. Let's see if it started working again. In our workspaces, there are scanners. So for instance, the bear call spread workspace that I just had open a moment ago had scanners to be able to identify potential candidates for bear call spreads. But one of the things I'm going to be looking at is what's going on with the volatility. And if the volatility is too high or too low, well, in this case, bear call, this would be a credit spread, which we're going to see in a moment. I'd be looking for high volatility. If the volatility is too low, I'm not going to be taking that position on this. I'd be looking for a different type of strategy. So let's get to the individual strategies, and we'll come back to deciding once we've gone through all the different strategies. So what is a bull call spread? This is a debit spread. I mentioned it was on the left column back here. Again, if we have relatively low volatility, we have bull call spreads for bullish. If we're bearish, bear put spreads. So a bull call spread, you basically buy a call. And typically, again, this is the anchor leg. It's going to drive the strategy and the profit because you're buying a call underlying you're bullish and you have positive delta, which means that you profit if the underlying prices go up, right? You typically buy an at the money or out of the money strike. Now, could you buy an in the money strike? Yes, you will have bigger delta. However, you also have a higher cost and your rate of return may not be as good. And you have to worry about the changes in the delta. It will not happen as much. Your gamma will be lower, and therefore it may not pan out for you as well. Typically, you're going to want at the money, and you're going to want to buy at a support level or demand zone. That's where you want that strike. You're going to then sell a higher strike call on the same security. Now, this is going to cap your risk and your profit because you cannot make any more than the difference between the two strikes minus the premium you paid. Okay, remember, you're reducing the premium you pay for that call by selling the higher strike call. And you're also reducing your risk by doing that. So you're reducing your profit and capping your profit. If prices go above the call you sold, you can't profit anymore, period, because that could be exercised or assigned, and then you have to exercise or assign your lower strike. The maximum loss, though, is limited to the premium paid. Now, do you have to have the maximum loss? No. That's the nice thing about options. Actually, on Monday, we did the options replay session, and you can check it out. It'll be on the website as an archive. You can watch the video. We talked about how you can place a stop loss to protect yourself so you don't have to lose the maximum. You can lose less if things don't work out in your position. The break-even price is nothing more than the long strike plus the premium you paid. Once you go above that, you start making a profit. The risks, obviously, we're going to have time decay risk. We're going to have positive delta, negative theta. And if volatility drops, we're going to lose. And if the underlying price drops, we would also lose. Probably one of the biggest risks that you always have with the bull call spread is the early assignment on the underlying short call. Okay? Anytime you sell an option, you run the risk of being exercised on that option. And there's nothing you can do about it. I mean, yes, we have a long option along with us, so we can offset by exercising our long option, but sometimes it just happens, even when it doesn't make sense. I've had options be assigned, even though they were out of the money for whatever reason. Now, we can avoid this by trading options on indexes that are European style. Most options on stocks and on ETFs are American style options. What that means is when you want to exercise at any time, you're free to. You can exercise any single time you want. But if you trade a European style option, you can only exercise or be assigned at expiration. So that would be like on the S&P index. You can trade those. Bull call spreads, again, the maximum risk is limited, but there is risk. Are US options cash settled? Yes. You cannot take delivery of the index, right? You could take delivery of a stock, you could take delivery of an ETF, but yes, the index options are cash settled because there's nothing to be exchanged typically. So not only do you get the benefit of the European option with no early assignment, but you also have the cash settlement, so you don't have to deal with the underlying security. However, again, when you're reducing risk, you're also reducing reward. Premiums may not be as high as they would be on the corresponding ETF like SPY, right? Because with the SPY, you're accepting that extra risk, whereas with the SPX or OEX options, you may not have that. So things are going to be priced accordingly. But again, there are still opportunities in both. So the maximum loss, again, is limited to premium paid, and volatility, if it drops, it's going to hurt a debit spread, period. There's nothing you can do about it. Time decay hurts as well. So typically, anytime I'm doing a debit spread, I want to buy enough time that's not going to affect me much. I want to buy enough time that when I'm planning on exiting the position, not entering, but when I'm planning on exiting the position, there should be at least 30 days left until expiration. So I have to kind of guesstimate how long I might be in the position and buy accordingly. So I almost never buy options that are 30 to 45 days from expiration because, again, the time decay starts going crazy too quickly. I'll buy 100, 150, 180 days until expiration. You might pay more for the option up front, but you get a lot of that money back when you liquidate the position and close it out because you recap most of the time value. It doesn't decay as fast. And again, the other risk is missed opportunity. If you go beyond the strike that you sold, you can't make any more money. If you just simply bought the call, you could. Also, dividends are not collected versus a covered call position because you don't own the underlying security. And what will happen is calls will typically drop in value when a stock goes ex-div. They may not drop at the same rate, though. You got to be careful of that. At the money, in the money, they might drop a little bit differently. So, I mean, obviously, there are things we can do to avoid those. Don't trade options on stocks that are getting ready to go ex-div. It's not that hard to check it out. You can look online to see when it is. So when do we want to use a bull call spread? Well, as I said, when we're bullish, we're expecting prices are going to go up, but not up like crazy. You know, if they're going to go up and up and up and up, and we're not going to want to sell something that's going to limit our profit, we're just going to want to buy a call in that case. But if we expect they're only going to go up to about a resistance level, why not buy an option to take advantage of the price going up and then sell a call at that resistance level? Because that's where you're likely to see it drop from anyway, or that's where you would sell it anyway. We can do this to lower our cost. Obviously, many people are choosing options trading to lower their costs over buying individual stocks, but using a spread is much cheaper than using an individual long option, call or put, because you're offsetting the cost of buying by selling another option. Now, of course, you're also reducing your reward at the same time. I mentioned that. There's always a little bit of a, quid pro quo. You give up a bit of risk, you got to give up a little reward, and vice versa. The advantages are, though, we can profit from upward moving markets. When we have low volatility expecting it to rise, we have some protection against downside movement in price and some on the volatility dropping as well. Those are some of the downside protections we get using a spread over the individual option. When it comes to picking the strikes, long call, typically at a support level or near, and the short strike at or above a resistance level. So here we have an example where I found a little bit of a demand zone and a little bit of resistance overhead. I could possibly get in when prices are near my support and sell the option above or at the resistance level because I know prices are likely to bounce from that area once again. So placing the trade, again, we're going to go into more detail on that in the options replay program, but it's pretty simple. You can go out to your chart and to the options quote. What I was going to say is that you can simply go to the option chain, hold the control key down, choose the one you want to buy, and then control again, choose the one you want to sell by clicking on the ask price to buy, the bid price to sell, and then your trade ticket would be opening up. You could choose natural or mid. The mid is the one that comes up automatically if you're using a limit order. However, that may not be the price you get filled at because that would basically be taking the difference. To try to get filled a little bit faster, we can use the natural price. That would actually be the retail price, though. That'd be buying from the ask, selling to the bid. I try to go somewhere in between. That way you're shaving a little bit off the natural price and not paying completely retail, but you're being reasonable and you're more likely to get filled on the option. You want to make sure you know your maximum profit and your maximum loss on the position as well, and then place your order. Make sure you analyze it properly first. Okay, this one, I just threw in numbers. I don't think this was a serious trade I was looking at. No, definitely not, because this is going long on the 108, short on the 114, and we're already at 114. So that's not a bull call spread, but again, it's just showing you on the screen. To exit the spread, though, we would close the spread out by simply selling the option we bought and buying to cover the one that we closed. So as I said before, when you're doing a debit spread, which the bull call spread is, you're paying a debit to get into the trade, exit that position, win, lose, or draw when there's roughly 30 days left until expiration. And you typically want to do that because the time decay is going to accelerate if you wait too long. And as I mentioned, we can go ahead and put in a stop loss to protect you as well. Jesus, maybe you can answer that question that Kato was just asking about. By the way, when we're using those orders, I mentioned the stop loss using the activation rules. Again, if you go back to Monday's option replay and watch the video, I mentioned both the stop loss and profit target orders can both be placed at the same time. And they can be done using the activation rules, which are a really powerful tool that TradeStation has available to you to be able to do that. Let me go through this. The bull put spread. If we are bullish and volatility is high, we could do the bull put spread instead. And this is a credit spread using multiple legs. The way this works is we're going to sell a put to collect premium. Again, this is the anchor leg, the one that's driving the profits. We're selling to collect a premium. At the same time, we're going to buy a put, and we're going to have to give up a little bit of that premium to buy this put. So the premium that we're selling, or the put that we're selling, is typically at or slightly out of the money. And the put we're buying is going to be deeper out of the money, so it'll be a lower price. Combining the two of those is not the same strike, but it is a different strike, as I just said, lower strike, but it is the same expiration date. So I apologize there, made a mistake on that. It is the same expiration date. And the thing is that you'll notice now with this risk profile, we can make money up to a certain point, and we can only lose money up to a certain point. So we've capped off the amount of risk that we have, but gave up a little bit of profit as well. So the way this works, again, if you're selling a put, you are going to lose from the strike price down to zero. The most you can make by selling a put is how much you collected in premium. So we're going to add in the long put, which is going to protect us because basically if you buy a put, you can profit from the strike price down to zero. Now, remember, these are not the same strikes. So there's where your risk comes in, the difference between the two. The loss is limited to premium paid, but since we collected more premium that we're paying, we actually come out with a net profit. So again, sell a put, buy a put, net premium. And that's the maximum we can possibly get in the trade, period. The nice thing about this position is we can profit if the prices go up, because we're bullish, obviously. We can even profit if they go sideways. And we can profit if they go down a little bit, as long as they don't go down below the put that we sold. And even if they do go below the put we sold, as long as it doesn't go below the break-even point, which is the put that we sold strike price minus the premium we collected, we can still make profit. But the maximum risk is if we go below the long put that we bought. And that risk is simply the difference between those strikes minus the premium collected. And I just mentioned the premium, the break-even price as well. So really, we can profit, like I said before, with a bear put spread, bull put spread. If prices were to go up, as you can see here, if prices go up, we make money. If prices stay sideways, we make money. And even if they go down a little bit, we still profit as long as it doesn't go below the break-even price. So that's kind of nice. I like that, where we can profit in 3 different directions of price versus the bull call spread. You can only profit one way. So there's more probabilities of winning here, but the winning will be smaller, right? It's capped reward to the maximum that we collect. We also still have risk of assignment. Okay, you can still be assigned on that short strike. Again, to try to avoid that or minimize the risk of assignment, you could trade European style options that can only be assigned at expiration. But again, the prices are going to be adjusted for that. We're going to use the bull put spread, obviously, when we're bullish, and it has a little bit more probability to profit, up, down, or sideways a little bit. However, we're limiting our risk, and the cost is going to be a bit lower than obviously buying the stock. And sometimes even doing a long call strategy, this is going to save you. Remember, we're putting down a margin deposit to collect premium rather than paying premium to enter into a position. So it may be more advantageous and give you a better reward, especially when you're looking at rate of return on your money, if we happen to be in a very high volatility environment. With volatility extremely high, options are very overvalued. That's where you want to typically sell options rather than buy them. And it reduces your need for accuracy. I can ballpark that, hey, it's going to go up. I don't know exactly how much, but as long as it goes up and not down, I can still profit on the bull put spread because I keep the premium, I collect it. The risks, obviously, are going to be that you could have a much bigger risk than you have reward. That's pretty much true on all the credit strategies. Whenever you're doing credit strategies and selling options, your maximum loss will be greater than your maximum reward. And it seems wrong, doesn't it? Because we're always told, oh, we should have much bigger rewards than our risk. We take small risk. Well, again, it's about probabilities. You will always have a greater maximum risk, but the probability of reward is slightly higher than it would be if you did the debit spread accordingly. Now, it's not a huge amount difference all the time. It's going to be individual cases, but case-by-case basis, on average, you're going to have a higher probability of a credit spread profiting versus a debit spread profiting. Again, because a debit spread only profits if you move far enough and fast enough in the right direction. The credit spread profits if you move in the right direction, if you move sideways, or even if you move a little against you, price that is. You always have that early assignment risk. Anytime you sell an option, you got to worry about that. Again, we can put a little bit of that away if we trade the European style options, but it may not always be what we want to trade. If you want to trade options on a stock, well, then you have to do the American style options and be aware that you have assignment risk and make sure your account has enough in it, enough capital in it to cover a possible assignment. That's another thing you need to be aware of. And of course, if there's a big price drop, that's where the strategy loses. It's a bullish strategy. We are expecting prices to go up, not down. Now, if we are expecting prices to go down, we have 2 strategies we talked about, a bear put spread. So again, using the puts, this one is a debit spread. We're going to buy a put and then sell a put at a lower strike to offset the cost. So we're buying a put option, usually at the money or maybe slightly out of the money is best. Again, it's a personal choice. You have to have your reasons for getting in. I typically don't want to buy in the money options because even though the delta might be slightly higher, the gamma doesn't accelerate the delta as quickly. And this profits from a decline in the asset. We're going to sell a lower strike out of the money put to reduce our cost, but reducing the cost caps the reward. And the put option appreciates because as negative delta, it's going to make profit when the underlying security drops. And at the same time, we're going to sell a lower strike. So unfortunately, we have to pay for the strike that we bought, but we're lowering the cost by selling the lower strike put. So the risks, obviously, this is a bearish spread. It's going to lose if prices go up rather than down. But the premium you paid is the maximum risk. Once again, you do not have to lose the maximum risk. You can put in a stop loss using the activation rule. And I mentioned, if you watch the options replay workshop that we just did this past Monday, I talk about how to do those things. Volatility. This will actually benefit from a rise in volatility because it is a debit spread. Even though prices are going down, we do want volatility to rise with the price going down. The faster it goes down, the better the volatility might be for us. If volatility drops, that hurts us because we want the value of the options to go up. But because it's a debit spread, we don't want time to decay quickly on us. Avoid holding with only 30 days till expiration. And we're capping off our maximum gains. If prices keep dropping and dropping and dropping, you miss out. There's always that FOMO, missed opportunity. And we also have to worry about early assignment. When a put is sold, bear put spreads will have a maximum loss than only buying a put. That's because you're selling a put to cover the one that you're buying. But by selling the put, you can't gain past that strike price, unfortunately. I'll look that up for you, Doug, where that indicator is. Somebody was asking about it earlier. I think it might be in the spreads. Let me just, again, log into my TradeStation. So when we're choosing strikes for a bear put spread, once again, we typically want to buy slightly at or out of the money puts. You get a little bit lower premium. If you buy deep out of the money, it's going to be very cheap, but you need a huge move because the delta is way too low. That's not necessarily the one we want to trade. Using in the money options has a much higher success rate, but the problem is you got to be careful. If you sell options that are near the money or in the money, you're going to have to go ahead and worry about the assignment, and they'll have lower profit potential, especially if you go deep in the money. So typically, I want to buy at the money or slightly out of the money. That's what I was mentioning earlier, and sell an out of the money option. That way we have a good reward risk ratio, we have a good probability of success, and we don't have as much worry about assignment because we're buying an at the money option, but selling an out of the money put, deeper out of the money, lower price. And finally, our bear call spread, the last strategy. This is a strategy that is a credit spread when you're bearish. So we're going to sell a call. This is our anchor leg. The most we can make is that premium we collect. And it's usually at the money or slightly out of the money. You could do in the money, but risk. To protect ourselves, we don't just sell a call. We're going to go ahead and buy a call at a higher strike on the same security. This is going to limit our risk. You see, we got those horizontal lines on those. So combining those, and again, it's not the same strike. It is the same expiration though. And the long call limits the position's risk, but because we're spending some of the premium we collected, we actually lower our reward a little bit too. And that's what it looks like, bear call spread. That's actually the same risk profile as the bear put spread. But instead of a debit, we're doing a credit here. So the way it looks, again, if you sell a call, this is the riskiest position you could possibly ever do in options. Selling a naked call without owning the security. The reason why is if prices go up, you lose money, and there's no limit to how high they can go up. It's infinite. In reality, it doesn't go up forever. It only seems that way when you're short. So the premium you collect is 100% the profit that you can make on this. So to cap that risk, get that arrow smaller, what are we going to do? We're going to buy a call, which actually has potentially unlimited profit, and the loss is limited to what you paid. So this arrow is going to eat into this one, and this arrow is going to cover a lot of this one. Not all of it, because they're not the same strikes. So the max potential profit, when you do this spread, you're selling a call and buying a higher strike call. As a matter of fact, this afternoon, I was looking at a bear call spread on the index, the SPX. Let's see if I can log in here real quick. I actually did 2 credit spreads on the SPX not that long ago. What I looked at was for the SPX that prices were going to stay below a certain level. So I do the bear call spread, and they're going to stay above a level. So I do the bull put spread, and prices stayed in between so far. We still have another hour to go. It looks pretty good. Anyway, the max risk for this spread, again, is the difference between the strikes minus the premium. And the break even is the strike you sold plus the premium you collect. Oops, sorry. Of course, anytime you sell an option, you run the risk of assignment on that option. So that's it for the slide deck. And I do want to get into the platform here. Hopefully it opens up. A lot of information under an hour. I know. Hopefully your head's not spinning too much. But like I said before, if you go to tradestation.com, which I don't have open right now, I thought I did. I closed the browser, I guess. But if you go to tradestation.com and you go to the Options Education Center, that basically all the links that Jesus has been providing for you, those are available for you. All the strategies, all that information is there that you can dissect in smaller pieces. Plus, this workshop will also be there as well. So this one, yeah, I'll keep this workspace opening. And like I said, one of the main things we're going to be looking at is obviously the chart to figure out which direction prices are likely to go. But then volatility is going to help me decide whether I should be a buyer or seller of that option, or the strategy in general. If we see that implied volatility is relatively high, okay, let me cancel this one. If you go into the individual strategies, you're going to learn more about each one and how to apply those. But hopefully this gave you kind of an overview. I'm going to have to turn the floor back over to Jesus because unfortunately we've run out of time. But if there's a couple more questions, I'd be more than happy to try to answer them if I can quickly. As far as the one question that came up about, what's going on with the OptionStation Pro, you can contact your representative at TradeStation to get more information if there's issues you're having with the OptionStation Pro. Or if it's an individual trade problem, then you want to contact the trade desk for sure.
Yep, exactly right. They'll be, the best people that can address those and troubleshoot your computer if there's any issues. And if there's a trade question, the trade desk can track your order and see what happened to it and answer any question related to execution or any status of your order. We have the specific articles and the specific webinars in the Options Education Center. So if any of the strategies that Brandon mentioned, we have the bull call spread, the bull put spread, the bear call spread, or the bear put spread, whichever one of those strategies you're interested in, we have a specific article on each one of them and a specific webinar dedicated to each one of those strategies. We did this more of a way of showing you all the collection of verticals that you can trade and how they are similar to each other and how they contrast each other. But we also wanted to point you to that additional education if you're interested. By the way, those presentations were also done by Brandon. So if you like his presentation style, I'm sure you enjoy those webinars as well. And that's it. We have the links in the chat. So make sure that you click those, bookmark them. They're part of the education or the Options Education Center. So explore all the items we have there. And if you have any questions, please reach out to us, education@tradestation.com. Let me put that email address right here in the chat, especially if you have any questions about the platform of possibilities that you, or possible strategies that you can apply on the platform. We're there for you. Brandon, thank you so much for your time. I hope to see you next time. Everyone, thank you for being here. Have a great afternoon, and we hope to see you next time. Please check the events calendar for upcoming sessions. Goodbye, everyone.
Real quick, if anybody's still here, the IV range percent is actually in the straddles for earnings download for the workspace. So it's in the straddles for earnings workspace, not the vertical spreads. I apologize. That IV range percent indicator.
Is that the one we customized, Brandon?
It is. That's the one that you created. Yes, Jesus.
Okay.
Yeah.
So
it's IV range percent.
And it's based on some of the indicators that are built into the platform. So if anybody needs that indicator, you can also, reach out to me via email and I'll forward it to you. Okay. Thank you.